All right, so let's start with chapter number one of financial accounting, which is accounting in action. So we will study accounting as a subject. The definition of the accounting, that would be the very first objective in the very first chapter. The second objective would be to understand about the users of accounting information and how they can use it. The third would be to understand the role of ethics in uh, recording and summarizing, also communicating the financial information. The fourth objective would be to understand a very important set of rules and principles. Of course, they're very comprehensive and very expanded, and they're called US GAAP as a short form. US GAAP is basically generally accepted accounting principles. They are international principles, and accountants all over the globe follow them. They are very extensive, but we're going to give a very brief introduction of some of the principles and some of the assumptions within GAAP, just to know that how they impact upon the recording of financial information and communication of the financial information. So there will be two assumptions that we will introduce very early on in this chapter, in the fifth objective, and they are monetary unit assumption and the economic entity assumption. Then, as a sixth objective of this chapter, we're going to study accounting equation. And this is what we call the basic accounting equation. This accounting equation also has an expanded form. It has a modified form, but we will see the basic accounting equation in chapter number one. And there will be three components of this accounting equation. Number one, assets. Number two, liabilities. Number three, owner's equity, right? So the seventh objective would be to analyze the effect of business transactions or events, economic events of a business on the accounting equation. So when we study accounting equation, we see that how this is impacted by the financial information or the financial events of a business, right? And then we're going to study the four basic financial statements. We will study their names, we will study their formats, but we're going to study them on the basic level, right? There is an extensive form of each statement, which we're going to study later on in this course. But in the first chapter, I will introduce their basic format and their purpose, right? Okay, so let's move to the first objective, which is the definition of accounting. Now, why we use accounting and who uses accounting? Accounting is used by everyone. It has to be used by everyone, right? Why? Well, consider yourself um, trying to calculating your own expenses and earnings, how much you have in your pocket and how much you have spent. I think that is a record everybody keeps every day. So when you start a new business organization or you are an employee of a business organization, you have to keep record of everything which involves money, because you will be asked that where did you spend the money, and the money which you receive from sources, different kind of sources, where is that and how much was that? Do you have any record of that? So these are the concerns where financial information is very pertinent. So if you don't keep a record of this financial information, your statements could be misleading. You could be taken accounted for certain actions that can be against you, right? So accounting is a subject which identifies, records, and communicates economic events of an organization to its interested users. Now, there are three basic activities which we need to understand the accounting performs. Number one, identification. And what we mean by identification? Identification means that the particular event which happened in the business is a financial event or not. It can be recorded in the form of money or not, right? So that is the first question. So if this is an economic event, which means it can be recorded in the form of money, like what are those events, right? Number one, if you purchase something, you are the business and you purchase a laptop, you purchase a new vehicle, you purchase machinery, you purchase land, building, you purchase shares of another company. All of these activities are economic activities. Again, what if you sell something? You sold your laptop, you sold your products, you sold your services, and those are also economic activities, and they are called transaction. So here we will define transaction. What are transactions? Transactions are activities within an organization that relate with money. They are economic event of a business organization. And what we need to do with the transactions, we need to record them. We need to record them. Okay, how do we record them? First of all, we classify them, and we will see different kind of classifications, right? We put every information in a particular account. For example, cash is different from machinery. Cash is liquid. Cash is in the form of currency. Cash is in the vault of the business. But machinery is a very tangible form of thing in placed somewhere where it is going to provide you long-term benefit, right? So you're gonna classify these two assets in different way, and then we summarize our uh, business resources in different areas. Like we say that there are certain accounts that we classify as assets, and there are certain accounts that we classify as liabilities, and some we classify as owner's equity or shareholders' equity for companies. Now, how we summarize these? We summarize them in the form of accounting reports. So we will see some basic financial reports towards the end of this chapter, which will help us to understand how information from this uh, source point, source point, where we have very raw documents, goes to very organized form of reports. And then these reports are published. They are given to users of those reports. What those users? Those users can be internal as well external users. Internal users include management, human resource, finance, marketing. These are different departments of the company or business organization that are very interested about the financial position of a business, how much money we have for our activities, how much we can earn from different activities of the department, how much business can invest to expand these departments, and also how much business can provide to the employees of the organization. Then there are external parties, for example, IRS, which is Internal Revenue Services, usually used in America, but in Pakistan we have FBR, Federal Board of Revenue, and they're gonna look into the financial statements of a business, that whether the business is making any profit or loss. If the business is making any profit, obviously the business has to pay taxes, and if there is some kind of loss, the business gets exempted from taxes. And then investors, like you have a bulk of money, you are an investor, you want to invest in company, and you want to know the financial position of the company. You also want to know how much money the company is making, and what is the expectation in the near future, that the company is going to earn profit or not, what is the profitability ratio over the years. So investors are also interested in financial information, because they're not going to invest in a company which is losing a lot of money over the time. Labor unions, like there are unions who take care of employees of companies, because companies sometimes they mistreat their employees. They do not give them bonuses, they do not give them proper pay raises, they do not give them leaves with pay. So these kind of issues are handled by labor unions, and they investigate the financial reports of the organizations of the companies, just to know that is the company able enough to provide these benefits to their labor or not. Okay, creditors. This is a very important term, and you're going to listen to this again and again. Creditors are the people who give money to the business as a loan. So when investor invest in the business, the investor becomes owner. So if you have a share of PTCL, or if you have a share of Kohinoor Textile Mill, you become the owner of that business because you have purchased a share of the ownership. But if you actually pay the money, and they give you a bond or something, a piece of paper that you have given them loan and they're going to return your loan in due time, you become creditor. So creditors are the parties that provide money to the business. They lend money to the business. Business is the borrower, and creditors are the lenders. Okay, one more regulatory body, which is SECP, Securities and Exchange Commission of Pakistan, a very important organization, a very important public institution because it regulates companies. And one of the basic needs of SECP towards companies is that companies have to submit their annual financial reports in SECP, especially public limited companies that are listed on a stock exchange, and because those financial statements include all the information, all the financial activities that happened during 1 year, and they are very relevant to know about the company, how the company is performing, what kind of business the company is involved in, and all that. Obviously, customers also look at these reports by because they want to know about the longevity of the company, that the company is going to stay uh, within a country for the near future, or the company is going to stay in business in the near future. These are the questions that customers also ask. Okay, so these are some users that we can differentiate. These are two different types of users: internal users and external users. Internal users are a part of the organization, whereas the external users are outside of the organization, but they both require uh, a check on the financial health and the financial performance of a particular business organization, and they can ask these kind of questions. For example, human resource department can ask that, can we afford to give our employees a pay raise or not? Investors may ask, did the company earn a satisfactory income? Should I withdraw my investment from the company, or should I invest more into the company? That depends upon the company's profitability over the longer run. Management would need to know, do we need to borrow in the near future or not? How many needs are arising? Are we receiving any money from the customers or not? So there are financial information that you are more concerned as a management in the financial reports. And same with other departments of the business organization. I will leave it to you. There are many other questions that different departments can ask. Think it for yourself. Try to come up with the questions that you think a particular department would be asking while looking at the financial information or the financial reports that we're gonna study, the very basic form of them that we're gonna study towards the end of this chapter. Okay.